your opinion. We have Mr. Morris, who is the Chief Market Strategist at BNP Paribas Asset Management, joining in. Again, the street expects 25 basis points with dovish commentary, and the street fears 50 basis points with hawkish commentary. What camp are you in?
We're leaning more towards the 25 basis point camp. If you look at either the growth data or the inflation data, our view is that it doesn't warrant a 50 basis point cut. If we start with growth data, it's not like we're seeing a deceleration that would suggest that the economy is slowing more quickly than the Fed would like. And on the growth front, if you look at the most recent CPI data, on a monthly basis, course inflation actually increased. So we're also not in a position to say that worries about inflation are not there anymore. So it makes sense for us that the Fed cuts 25 basis points, and we then anticipate 2 more cuts at 25 through the end of the year.
Okay. All right. So you're not expecting the decision to be front-loaded. But Daniel, we just had some opinion right before this indicating that maybe the Fed needs to be front-loaded because this decision has come 1 quarter too late. It was probably expected or it should have been in July, and it's come in September, and hence it should probably be 50 basis points in terms of a cut as compared to 25 basis points. What's your reading on that?
Well, of course, hindsight's always much better than foresight. We wouldn't necessarily take that view. We think this is the right time. And I think the reason for that, and I guess that inevitable phrase, why is it different this time? We have to appreciate that coming out of the pandemic, I mean, that is the source for all this inflation that we are still dealing with today, has really made all the Fed's economic models much less predictable, if you will. We don't have a historical precedent to look at to say this is what should happen with growth or with inflation. Hence, the Fed has inevitably had to be a bit delayed in its reaction. So if we had perfect foresight, if we had perfect models, then yes, maybe it will turn out that July would have been better. I don't think it's clear at this point, and hence we think September is the right time for them to begin cutting.
What would you, like from what the comments Jay Powell will make today? I mean, what is it that you're looking forward to here?
Well, I think what the market's going to want to hear is, I guess, 2 views. One, their outlook, their confidence that inflation will continue to decelerate, as we've seen in the forecast that you showed a bit earlier, because ultimately that is what needs to happen. We do need to get back to 2% core PCE, say in the next year, well, 2 years more likely. And then at the same time, the relative softness that we've had in the labor market, a view that that's not going to go much further, that we're going to get back to a run rate of growth for real GDP a bit under 2%, as opposed to that deceleration in growth, that slowdown in the labor market going much further and ending up in recession. So some, if you will, comfort on the outlook for growth, that yes, growth is slowing inevitably, as it should, but that it's not going to go so far as a recession. And that is what will allow inflation to get back to target in a reasonable time.
Okay. Well, Daniel, this decision by the Fed and the meeting also comes on the heels of a big development which has taken place geopolitically with regards to Israel and Hezbollah as well. Do you think that could probably weigh on a decision simply because there is a fear that there could now be an escalation which could take place, and that could probably have an impact on commodities and in general the geopolitical status of at least the Middle East and Israel?
Well, purely from a market point of view, which is what the Fed is going to be thinking about primarily, their concern would be, would any events in the Middle East, say, lead to a sustained increase in oil prices and that pushing up inflation? So that's what they're going to be thinking about. If anything, of course, we've seen oil prices relatively weaker over the last year or so. So at least so far that hasn't happened, but it is certainly something that's going to be in the back of their minds.
When you're talking about monetary policy, you also can't ignore the impact of fiscal policy going forward. And towards the end, we have the US elections as well. In light of that, what do you think would be the challenges ahead of Fed Powell?
Well, absolutely. You're right to highlight that the fiscal outlook for the US is not particularly good. We appreciate that debt levels, not only in the US, but globally, have gone up. We no longer have extremely low policy rates or interest rates, and hence the interest on a much bigger pile of debt is higher. And that raises questions about the sustainability of the budget deficit forecast for the U.S. So that's actually one reason in terms of our outlook for interest rates. A lot of our portfolio managers favor what we call steepeners, which is to say that long-term interest rates will, relative to short-term interest rates, go up more. And one of the reasons for the expectations that long-term interest rates either will go up or will go down less than short-term, given that the Fed is cutting, is that expectation that with high budget deficits, there is going to be a premium that foreign investors or investors in general are going to want to require or want to have for investing in longer-term U.S. debt. So that means, again, on a relative basis, higher rate. So it is absolutely a factor, not something the markets are thinking about today, because there's many other things to keep us occupied. But at some point, we anticipate it will matter quite a bit.
Okay, all right, Daniel, we're going to leave it on that note. Thanks very much for joining in and speaking with us. Well, on to some good news for your viewers. India's business news leader is now just a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Google or the Apple Store.